All right, let's jump right in. We're about to pull back the curtain on a corner of the venture capital world that, for a long time, nobody really talked about. But now, it's becoming one of the most critical parts of the entire system. This is a story about a huge industry-wide problem and a surprisingly elegant solution that's changing the rules of the game in Silicon Valley.
And this quote just says it all, doesn't it? For literally decades, the venture secondaries market was the afterthought, the thing nobody really paid attention to. So why was it ignored? And what in the world is it anyway?
At its core, it's pretty simple. It's all about creating liquidity. Think of it like a stock market, but for private companies, the ones you can't just go and buy on the NASDAQ. So if you're an early investor and you need your cash back before the company has that big IPO, this is where you go. It's basically a much-needed release valve for a system that's built on incredibly long-term bets. And let me tell you, that release valve has never, ever been more important than it is right now. Because the entire venture capital ecosystem is staring down the barrel of a massive liquidity crunch. The pipes are just clogged, and the pressure is building up big time.
So here's the heart of the problem. A typical VC fund is sold to investors with a 10-year lifespan. That's the promise. But today, that 10-year promise has stretched out to an average of over 18 years just to get all the money back. I mean, think about that. It completely breaks the model and puts this incredible strain on investors who are counting on getting their cash back way, way sooner. And you can see the direct result of that delay right here. This chart shows what's called the distribution yield. It's a fancy way of saying how much cash are these funds actually returning to their investors. And, well, it's hovering around 5%. That is near the lowest level we've seen since the global financial crisis. The cash just isn't making its way back out.
So what happens when the money doesn't come back? Well, this is the knock-on effect. Because investors aren't getting paid back from their old funds, they have a lot less cash to put into new ones. And that has led to a jaw-dropping 56% drop in venture capital fundraising in 2024. The whole engine is just running out of fuel. And it gets worse. The little bit of fuel that is left in the tank, it's getting super concentrated. Take a look at this. Of all the capital raised in 2024, a staggering 60% of it went to just 20 of the biggest, most established firms. This completely squeezes out hundreds of other funds and makes that liquidity problem even more painful for most of the industry. So you take all of this together and it creates a problem that people in the industry call trapped NAV, or trapped net asset value. It's this enormous mountain of paper wealth, the supposed value of all those amazing startups that's just stuck inside these old funds. It's valuable, sure, but it's not cash, it's trapped.
And just how big is this mountain of trapped value? Well, it's $250 billion. Let that sink in. $250 billion in value is locked up, unable to get back to the investors who put up the money in the first place. This isn't just a small problem, this is the scale of the crisis.
Okay, so a problem that massive needs a pretty powerful solution, right? And this is the moment. This is where the venture secondaries market, that once ignored, red-headed stepchild, finally gets its day in the sun. There are really 5 key things fueling this boom. We've already talked about the first 2, right? The historic lack of liquidity and that massive pileup of trapped NAV. But the real game changers are the new tools, like fund managers, the GPs, proactively setting up sales themselves, and the now common practice of selling a piece of just one single amazing company instead of a whole basket of them. These things are unlocking that value in ways that just weren't possible before.
But this boom isn't just about financial engineering. It's about a complete and total shift in perception. What everyone used to see as a market for, well, leftover junk is now seen as a market for the crown jewels.
I mean, this timeline says it all. Look at the growth of those GP-led deals we just mentioned. Before 2016, this was a tiny niche activity. Today, it makes up almost half of the entire secondary market. It's gone from this weird, rare thing people whispered about to a totally standard, mainstream financial tool.
And this quote just perfectly captures that old attitude. The early pioneers in this space were literally called garbage collectors. The thinking was, if a venture fund is trying to sell something, it must be because it's bad. I mean, nobody sells their winners, right?
Wrong. So wrong. The so-called garbage being traded today includes stakes in some of the most valuable, most sought-after private companies on the planet. We're talking about SpaceX, Stripe, Databricks. The perception has done a complete 180. These aren't leftovers, these are the blue chip stocks of the private markets. So what this all really means is that the stigma is just gone. Top-tier venture firms and the unicorn companies they back are now actively encouraging secondary sales. It's not a sign of weakness anymore, it's seen as a sign of a healthy, functioning ecosystem that actually needs liquidity to survive and grow.
Which brings us to the future, because this isn't just a temporary trend. It's not just a quick fix while the IPO market is slow. No, this is a permanent structural shift in the fundamental mechanics of how venture capital actually works.
And if you want to see just how much room there is to grow, just look at this comparison. In the more mature world of private equity buyouts, about 3% of the total asset value gets traded on the secondary market every year. In venture capital, it's just 0.4%. That suggests the venture's secondaries market is still in the very, very early innings. It could easily grow 5, maybe even 7 times from where it is today.
And here's the roadmap for where venture is probably headed. Today, in the private equity world, more than half of all exits, are not IPOs or sales to giant corporations. They're sales to other financial buyers, like another private equity fund.
And this right here is the key takeaway. This financial buyer exit model, which used to be really rare, is now the primary engine of liquidity for the entire buyout industry. Venture capital is simply on the same evolutionary path. It needs this engine to be able to function at scale.
So that leaves us with one final kind of provocative thought. For decades, the ultimate dream in Silicon Valley, for every founder and every investor, has been ringing that IPO bell on Wall Street. But as this new secondary market matures, is that going to change? Could the new dream be a clean, efficient sale to another long-term investor? One that provides that critical liquidity without all the headaches of being a public company? It's a fundamental shift in what success could even look like.